Welcome back to the Engineered Impact Podcast. Today, we are going to continue talking about inflation. Okay, in the last episode, I kind of introduced the topic of inflation and we talked about what it is, right? And essentially, inflation is the fact that we see it as prices going up, but really what's happening is the purchasing power of the dollars in our wallet is dropping every single year. And essentially, the reason that happens is governments have a nasty habit of spending more money than they bring in tax revenues. And so to cover the difference, they borrow money. And in a lot of cases, that borrowed money is printed out of thin air by a central bank. In the United States, that central bank is the Federal Reserve, right? So they essentially create more dollars, and it's kind of a supply and demand thing, right? As the supply of dollars goes up, the value goes down. And so every year, your dollars will buy less and less, right? Now, on a year-to-year basis, that's not that big a deal, right? Historically, inflation's been about 3%. You don't tend to notice that from one year to the next. But over the course of 40 years of a typical career, over the course of a typical lifetime, the purchasing power of your dollars will drop precipitously, right? Meaning the dollars you're saving today, by the time you go to retire, you will need way more dollars to buy the same amount of goods and services that you could have bought today when you saved those dollars. Okay. So that was kind of what we talked about in the last episode. And I highlighted the fact that when I years ago calculated how much I was going to need in retirement, the number that I came up with was $8.3 million to live the equivalent of a $90,000 a year lifestyle for 40 years. Okay. And the biggest thing contributing to that was inflation, because every single year, inflation was just silently eating away at the value of what I could purchase with the dollars. And so I needed more and more and more at the beginning to make up for that and allow me to continue to buy the same amount of stuff, $90,000 worth of stuff for 40 years, right? So $8.3 million was never going to happen. Unless you make way more than me, that's probably never going to happen for you either. So what do we do about it? What does a normal person do about it? Okay. Well, if you go and talk to your financial advisor, he's probably going to tell you, don't worry about it. The money in your 401k is going to grow at 5 to 12%, depending on what model he's using. And inflation's only 3%, so you're good, right? Well, if you really get those rates of growth, yeah, you'll probably be okay, right? The value of your dollars is going up ahead of the rate of inflation. But there's a couple things that can happen in there that might throw a wrench in that. One, we got an example of this in March. COVID came around and stock market dropped 30% in a matter of days, weeks, right? Now, they've come roaring back, but the only reason they've come roaring back is because the Federal Reserve created trillions of dollars out of thin air, pumped it into the financial markets, and they went back up, right? Personally, I don't want to bank my future on the results of a bunch of funny money going to the stock market, right? That growth had nothing to do with the value of the businesses. I don't want to buy assets that can't stand for themselves. So that is an option. That's what your financial advisor is going to tell you. I don't want to bank my future on that. Okay. So what other options do you have? Well, there's a couple of things that we have to consider, right? One is just purchasing power preservation, right? So for dollars that you don't need to spend this year, all you need is for the value of those dollars to essentially remain the same, which means they need to go up as the value of the dollar drops. Okay. Now, typically the way that you can do that is buying any kind of hard asset, right? That might be gold and silver. That might be land, just raw land. It could be real estate. It could be any kind of commodities, food, ammunition, tools. And we've seen all kinds of crazy things used in different stories around the world when countries got into these high inflation scenarios and people were ditching their currency for whatever they could get that was real, that was tangible. Okay. And so for dollars that you don't need immediately, that's a good way to just preserve the value. Okay. Is trading those depreciating currency units for something tangible. Okay. Now, the next problem that you're going to have though is you do need money to live on, right? I follow a blogger that he and his fiance, I guess, a couple of years ago, cashed in all their retirement accounts, all their savings accounts. They bought a bunch of physical gold. They buried it in a hole somewhere, and then they took off with their kids and they're traveling the world, right? Well, that sounds great. And, he's going to preserve his purchasing power as, the value of the dollar continues to decline. The problem is, and people ask him about this all the time, how the heck are you living, right? Because a bunch of gold coins or gold bars or whatever he bought sitting in a hole somewhere in who knows where won't feed your family, won't put gas in your tank as you're driving around the country, right? So how the heck are you living? Now, I've never seen him answer that question. He may have, and I've just missed it. But the other thing we got to figure out is, how do we generate cash that will keep up with rates of inflation? Okay. And essentially what we need is assets that will generate cash flow. Okay. So there's a couple of different ways that we can do that. One, and my favorite way to do that, is buying an asset that cash flows regularly, and that those cash flows will increase over time as inflation goes up, okay, or as the value of the dollar goes down. So probably the three best ways to do that are, one, owning a business, okay? Now, it doesn't have to be full-on, business full-time. You employ 100 people, right? This could be a side hustle of you selling cookies out of your trunk or whatever, right? Selling something out of your trunk. Because as the value of the dollar goes down and your costs go up, your ability to charge more also increases, right? If it costs me more to make cookies, I have to sell those cookies for more to recoup my costs and still make a profit, right? So you can raise your prices as inflation goes up. That increases your income. And on a real basis, you're not making more, right? If I start out charging $6 a dozen for cookies, and 10 years from now I'm charging $12 a dozen for cookies, technically I'm making twice as many dollars, but I'm probably only buying about the same amount of stuff, right? That $12 will buy me the same amount of stuff that $6 would 10 years earlier. Okay. So that's the idea. We're not getting richer necessarily. It's just that we're preserving our ability to buy the same amount of goods and services with the higher number of dollars that we can command. Okay. Now, the next best way to do that, and the reason I say a business is the best, is just because you have so much control over that, right? You can control your inputs to the business, your costs. You can control how much you charge to a degree. The market obviously helps set those prices, but if the cost of everything is going up, then the market will expect that your prices will go up as well. Okay. One of the next best ways to do it is rent. Okay. Owning real estate or anything else that will have cash flows that adjust over time. Okay. Owning a piece of rental property, you can raise your rents, every year, every time a tenant moves, whatever it is, over time, as the value of the dollar goes down, the rents that you can charge will just naturally go up. That's just what happens. That's part of the process that's a manifestation of what happens when the value of the dollar goes down. Okay. So owning rental property is a fantastic way to do it. Owning a business is a fantastic way to do it. Dividends on stocks, I don't know. Again, I'm just not a huge fan of the stock market. I don't like the fact that the value of my principal can drop so precipitously and that I have so little control over it. So dividends will probably go up over time. Yes, I just don't want the risk that comes with owning the assets I have to own to earn those dividends. Okay. Now, if it's a business that I actually own, I'm not just buying stocks of Exxon or shares of Exxon or whatever in the stock market. If it's actually a business that I have researched, I understand, I have made an investment in, I can actually influence how it's managed, that's a different story, right? Because you actually have some sway over that business. The profits that you're earning from that are probably much more predictable. You have more influence over them. So in that case, dividends from that kind of ownership, I would be all about. Okay. And again, as that business is able to charge more for its goods or services, then I would expect that the dividends I receive as an owner would also go up over time. Okay. So that could be a good option. Fourth good option is the vehicle I've talked about numerous times, right? Owning a whole life insurance policy, because the cash flow that we get is roughly pegged to inflation, right? As the insurance company is able to earn more because interest rates are going up in the economy, the rates that they pay me will go up to compensate for that to some degree. Okay. So that's not a vehicle that will necessarily make you rich and I want to bank my whole future on, but for dollars I'm just going to set aside and save, that's a great opportunity. Okay. And one other thing I wanted to talk about is using debt. Okay. Now, I hate consumer debt in general. I think it's financial cancer, especially things like credit card debt, student loans, garbage like that will just eat you alive, right? But debt used to acquire assets is a phenomenal way to combat inflation. Okay, and let me give you an example. If you buy a piece of rental property, you have a couple of options, right? You could save up 100% of the cash. Let's say you're going to buy a $100,000 rental home. You could save up $100,000. You go pay cash for that property. You get to keep all the rents, right? But another option is you could take $20,000 to a bank, show them the property, and have them give you $80,000, right? So the bank is going to pay for 80% of your asset, okay? Now, how does that help me with inflation? Well, first off, it's pretty slick because I only had to put 20% of the money down, right? But where inflation comes in is if I buy a house that's, again, about $100,000, my payment on that is going to be somewhere in the neighborhood of $420. Okay, I think is the math I figured out. 30 years from now, when I pay that loan off, the equivalent of that $430 is about $110. Okay. So it's like, so over the 30 years that I own that, as the value of the dollar declines, the last payment I have to make is the equivalent of about $110 today. So what's happening is over the course of time, the dollars that you borrowed, you're getting to pay back with dollars that are worth less and less and less, meaning it's easier and easier to come by them, right? Again, the value of the dollars is dropping because there's so many more dollars in the economy, meaning there's more of them to grab. It's easier to get them. Meaning I don't have to work as hard to earn the same amount of dollars, right? That's why, today as an engineer, maybe you make $100,000 when somebody 40 years ago was only making like $12,000, right? It's not that we're worth so much more today. It's just that the dollars are worth so much less, right? Same principle. The dollars that you'll be earning 30 years from now when you have to make that last payment will just be worth a lot less. And so they'll be easier to come by. So debt is a great hedge against inflation because it will be easier and easier and easier for you to pay that debt off over time. Okay. Now, if you're thinking about it, this is exactly what the government's trying to do, right? The government is racking up massive debts for stuff that may or may not be worth what they're paying for it, but they're racking up massive debts. The reason they're trying to create inflation again is to reduce the value of those debts. The only way they can sustain the debt levels they've racked up is by paying it back with dollars that are worth less and less, right? Well, we can learn from that. We can either be victims of that, or we can learn from it and say, shoot, I can do the exact same thing, right? I can use debt to acquire an asset that will cash flow and pay it back with dollars that the government is devaluing over time. And it gets easier and easier and easier for me to do that, right? So really powerful strategy that you can use. Now, I want to be very clear. I would only do this for assets, right? Don't go out and rack up your credit cards and buy a Lamborghini and rack up a bunch of consumer debt because Dan said that, those dollars are going to go down in value, right? Between now and 30 years from now, I'm pretty confident that the value of the dollar is going to plummet, right? But between now and 6 months from now, when I've got to be making payments on a Lamborghini and paying off my credit cards, who knows what's going to happen, right? Inflation works generally slowly over time. So don't go out and rack up a bunch of consumer debt, but using debt strategically to acquire assets is a very, very good way to mitigate the effects of inflation, especially if you're buying an asset that will cash flow, where you can increase the cash flow and the value of the dollars that you're having to pay back is going down, right? That increases essentially the value of what you are collecting as the owner. Okay. So those are some strategies that you can use to deal with debt. Next episode, we're going to talk about one other way that we can use real estate to kind of take advantage of what's going on in the economy right now. All right. So that's what we've got today. I will catch you in the next episode.